Welcome back to the Market News Brief, the show where we take real estate news that sounds complicated, expensive, and vaguely threatening, and we translate it into plain English. I'm Mickey Lawrence, licensed realtor in Georgia and Texas, which means when I talk about Atlanta and Houston, I'm not reading somebody else's market report. I'm licensed in both. I have clients in both. I've sat at closing tables in both. Book it. And the whole point of this show is simple. I'm not going to tell you what the news means for the economy. I don't care about the economy. I care about your payment, your equity, your closing date, your peace of mind. Real quick, if this is your first episode, welcome. Episode 1 dropped a few weeks ago, and the response was honestly better than I expected, not gonna lie. A bunch of you sent messages, a few of you sent questions, and one of you told me I say, here's the thing too much. So here's the thing. Oh, okay, my bad, sorry. You're right, I do. I'm gonna stop saying here's the thing a little bit less. I'll say it a little bit less. Here's what we've got today. Insurance, the real story, with real numbers in both my states. Mortgage rates, which are doing something interesting by not doing anything at all, and we'll get into it. July's existing home sales report, what the Fed does in 3 weeks. Builders who are still giving away money and people ain't talking about it. You don't even know it, I'm telling you. A story about my own industry that I did not expect to be reporting on. And then the main event, a full playbook for anybody planning to buy a house in 2027. If you get one useful thing out of the next half hour, hit subscribe. That's the whole deal. Let's go. So for our first story, insurance is the line item eating your budget. Let me start with the real conversation because this is not a theoretical conversation for me at all. So check this out. I had a buyer this summer, pre-approved, solid, knew exactly what they wanted, y'all. Comfortable at their number and everything. We found the house, and it was a great house. And then the insurance quote came back and woo! The monthly payment they'd been planning their entire life around went up by a couple of $100. Not because the price changed, not because the rate changed, because of a line item they'd been treating as a rounding error. Y'all, that line item was the insurance. That's the story of 2026 in my 2 states. And here are the actual numbers. Georgia, home insurance rates went up 8.6% in 2025 against a national average of 5. Cumulatively, Georgia premiums are up 39.7% since 2021. Wow, that's a big number. The statewide average is running around $2,640 a year for $350,000 in dwelling coverage. Atlanta specifically prices higher than that. Estimates for the metro range roughly from $2,772 up to about $3,400 a year, depending on whose survey you read. In Texas, between 2019 and 2024, the median Texas premium rose 60%. 6-0. The national median rose 30%. Texas didn't just beat the national average, y'all. Texas doubled it. Check that out. That's Dallas Fed research, published this April. So that's up to date. Now the good news, and there is some good news in, not such a kind of a little bit of a gloomy area. That same Dallas Fed research says that the pace slowed dramatically. Texas homeowners insurance growth went from 18.7% in 2024 down to 4.3% in 2025, per the Texas Department of Insurance. Read that carefully though. The rate of increase slowed. The premium did not go back down. You're paying 2024's increase plus 2025's increase forever. Insurance is a ratchet, not a rubber band. So why does this matter? Because your lender doesn't care that insurance is expensive. Your lender cares that your debt to income ratio still works. So that DTI, those numbers got to be right. Here's the mechanic nobody explains. When you get pre-approved, the lender estimates your taxes and insurance to calculate your monthly payment. That number goes into your DTI. If the real insurance quote comes back way higher than the estimate, your payment goes up, your DTI goes up, and you can get denied on a house you were already approved to buy because of that rounding error. Remember that, right? I have watched this happen, not to me, thank God, but I've watched it happen to others' agents' clients and had to explain to my buyer why the house came back on the market, making my job harder, making me have to do a little extra work, as if my job isn't hard enough as it is. But we'll talk about that another day. Who's affected? Buyers. Your pre-approval is an estimate, not a promise. Get a real insurance quote on the specific address in the first 48 hours after you go under contract, not week 3. that's too late. You might get some bad news in week 3 that you can't back out of. This is the part sellers miss. Your buyer's insurance quote is now a deal risk on your transaction. If your roof is 18 years old, or you've got knob and tube, or your electrical panel is a brand insurers have blacklisted, you can lose a buyer in the option period over something you thought was the next owner's problem. Yep, you got to double check all the things now. Ask your agent what your house is going to quote before you list it. You need to know that insurance quote before you list the house. And to my homeowners, pull your declarations page today. 2 things to check. Number 1, dwelling coverage versus actual rebuild costs, not market value, rebuild costs. Construction costs went up 2020 through 2024, and a lot of policies never got adjusted. If your house burns to the ground and your policy says $280,000 to rebuild a $400,000 house, you find that out on the worst day of your life. That's when your house is burned down and you need to rebuild it, and you find out that you can only build half the size of a home because that's what your policy states. Number 2, your wind and hail deductible. Is it a flat dollar amount or a percentage? Because 2% of a $500,000 rebuild is $10,000 out of your pocket. That's real money out of your bank account before the insurance company writes you a single dime. Most people have no idea which one they have. Investors, run insurance as its own line in your pro forma with an annual escalator. If you're underwriting a rental on a static insurance number, your 5-year returns are fiction. Here's what the pros say. There was a piece in Real Estate News at the end of July that got at exactly the right thing. Annie Hannah Engel, president and COO of Howard Hanna Insurance Services, said this, and I'm quoting because she said it better than I would, trust me. We want to work in really tight communication with the real estate agent early on so that the buyers know what they're getting into. Early on, not at closing. Her colleague Marianne Hall added the practical piece, document every upgrade, new furnace, new AC, new water heater, new roof, send it all to the insurer. Her line was, there's no such thing as too much information, so there's no such thing as TMI. That's real money. Those documents can move your premium. And Hannah Engel did one piece of optimism. She expects premiums to ease up a little bit in 2027 as carriers adjust their underwriting and consumers get smarter about the improvements that actually matter. I'd love for her to be right. I'm not budgeting like she is, though. And locally, this is what's happening. In Georgia, the driver here is Hurricane Helene in September 24. Catastrophic flooding and wind damage across the mountain communities, the Augusta area, and parts of metro Atlanta. Insurance Commissioner John F. King has pointed to inflation, labor and materials costs, and major storms like Helene. Add 20 plus tornadoes a year and a whole lot of hail claims, and you get the filings we're seeing. Georgia has had a 189% increase in billion-dollar natural disasters over the last 2 decades. Houston, you already know. Wind, hail, flood, and the coastal exposure that carriers price accordingly. And Houston homeowners carry an extra burden the rest of the country just don't carry. For Texas owners without a mortgage, insurance eats 14.9% of household housing costs. With a mortgage, 7.9%. Both up about a point since 2019, though. Bottom line, insurance is no longer a closing day formality. It is a qualification issue, a negotiation issue, and a deal killer. Get a quote in the first 48 hours after you go under contract. 48 hours, go get that quote and pour your own declarations page tonight. Drop a comment below if you had the opportunity to pull your declarations page. Let us know if you have a percentage or a flat fee. People want to know. Story 2, mortgage rates hold at 6 points. Here's what happened, y'all. Freddie Mac's primary mortgage market survey for the week ending August 13, 2026, the 30-year fixed averaged 6.67%. Prior week, 6.69%. A year ago, 6.58%. The 15-year fix came in at 5.96%, down from 6.01%. Freddie Mac's own read, mortgage rates, and I quote, mortgage rates remain relatively stable this week at 6.67%. Housing affordability has improved from a year ago, and recent increases in purchase and refinance applications suggest that borrowers continue to respond to even modest changes in mortgage rates. End quote. Why it matters. 2 weeks ago, I told you rates hit 6.66%, and that was the summer high. This week, 6.67%. That is not a trend, that's a plateau, good people. And the plateau is the most useful thing rates can do for us because a plateau is negotiable and it's not a spike. When rates are climbing fast, sellers panic and buyers freeze and nobody can price anything. When rates sit still for a month, everybody can actually do math, settle in and let your brain work a little bit, or AI. Here's the number I want you to hold on to. On a $400,000 loan, moving from 6.58% to 6.67%, the entire year-over-year increase cost you about $24 a month. $24. Meanwhile, we're about to talk about markets where sellers are cutting prices and builders are handing out incentives worth tens of thousands of dollars. The rate is a rounding error. The negotiation is the whole game. Y'all catch that? The negotiation is the whole game. And most buyers have that exactly backwards. This is who's affected. Buyers, stop refreshing rate trackers. Start tracking days on market and price reductions in your 3 target neighborhoods. That's where your money is. Homeowners with rates above 7.5% especially. Watch this. If we get a meaningful move down, you want your lender's number already in your phone, documents already gathered, everything ready to go because the refi window closes fast because it closes for everybody at the same time. Rate stability means your buyer pool isn't shrinking anymore. It also isn't growing. Price it accordingly. Remember, days on market really impacts your bottom dollar, but we'll talk about that on another episode in the future. The bottom line, rates went sideways at 6.67%. Sideways is opportunity. Quit negotiating with the bond market and start negotiating with the seller. That's where the deal is. Story 3, existing home sales, the flat market. So here's what happened. NAR's July existing home sales report released mid-August. Sales ran at 4.06 million, seasonally adjusted annual rate, down 1.7% from June, but up 0.7% from a year ago. Median existing home price, $434,100, up 2% year. That's the 37th straight month. Did y'all hear that? That's the 37th straight month of annual price gains. Just saying. What crash? Inventory. 1.54 million units, down 1.9% from June, a 4.6 month supply. Median days on market, 29 days, up from 28. 1 day difference, relatively flat. First time buyers, 29% of sales. All cash buyers, 26% of sales. The report's reference mortgage rate was 6.54%. And in the South, my region, both my states, sales ran at 1.86 million annual rate, down 3.1% month over month and flat year over year. Median price in the South, $371,700, up 0.9%. NAR chief economist Lawrence Yun said home sales have been remarkably stable even amid the rising mortgage rate environment of the past few months, and pointed out that the year-to-date sales are up 2.4%. Why does this matter? 37 consecutive months of price gains. Let me put that next to the thing people keep saying to me at open houses. Somebody tells me they're waiting for the crash roughly once a week. 3 years running now, and for 3 years, prices have gone up every single month. Not fast, 2%. 2% here, 2% there, but it's up. Here's what up 2% actually means for a real person. If you'd bought a $400,000 house in July 2025, you'd have about $8,000 in appreciation right now. That's just from buying summer of last year. Plus roughly a year of principal paydown. And you'd have spent that year not paying somebody else's mortgage. That's not a get rich quick story. That is the boring machine that has built more middle class wealth in this country than any other single vehicle. Period. The 4.6 month number. 4.6 months of supply is the most important number in this report, and it gets the least amount of attention. Under 4 months is a seller's market. Ain't nobody talking about that. We are so close. Over 6 is a buyer's market. 4.6 is genuinely balanced, and we haven't had genuinely balanced in a long time. Balance means you get an inspection. Balance means you get an appraisal contingency. Woo, we missed those. Balance means you don't have to write a letter about how much you love the seller's kitchen backsplash. And you really don't, you just want the house, right? Balance means being a normal buyer works again because this is just a balanced, normal market. something we haven't had for a while, right? For anybody who got shellacked in 2021 and 2022, you lost 11 offers and gave up. The market you lost in does not exist anymore. Let me tell y'all about who's affected. Buyers, 29 days on market is your leverage. When a house has been sitting for 40, 50, 60, 70, 80, 90 days, especially 90 days, woo, the seller has had 6 weekends of nobody showing up, 7 weekends, 8 weekends, 9 weekends, 10 weekends of nobody showing up. That's a conversation to hold. Sellers, 29 days is the median. Half of everything takes longer. Price it right in week 1 because week 4 is where the money dies. We all know this. And potentially your property may not get sold. Investors, 26% means you're still competing with cash. But the days of cash automatically winning are over. Certainty is beating cash right now. A clean, fast, well-documented financed offer beats a sloppy cash offer more often than you think. The bottom line here, price is up 2%, supply balanced at 4.6 months, home sitting 29 days. This is not a crash. This is not a boom. This is the first normal market in 5 years. And normal is the easiest market to buy a house in. Remember, I told y'all last episode, it's kind of like watching paint dry, this market. But man, there are some deals in watching paint dry. There's deals in the beauty of patience. Now, time for story 4, the Fed September problem. Here's what happened. The Fed held rates at its July 28th and 29th meeting, keeping the federal funds target at 3.50% through 3.75%. The next meeting is September 15th through 16th. Inflation is running around 3.4% annually, down from 3.5% in June. That's cooler, and cooler is what the doves on the committee have been waiting on. Let's go. Why it matters, and here's what most people get wrong. Fed does not set your mortgage rate. I'm going to say that again because every September when the Fed meets, my phone lights up with people asking if they should wait until after the meeting to lock in. The Fed sets the federal funds rate, an overnight bank-to-bank lending rate. Your 30-year mortgage tracks the 10-year Treasury yield and mortgage-backed securities pricing, which move on inflation expectations, growth expectations, and what the bond market thinks, keyword thinks, about the next 2 years, not what the Fed did this morning, which is why you've seen it happen. The Fed cuts and mortgage rates go up because the bond market already priced the cut in 3 weeks ago and is now worried about inflation. What the Fed actually controls in your life, credit card APRs directly, HELOC rates directly, home equity lines of credit mostly, maybe not directly, but mostly. Auto loans has a big part in it, and construction loans. Yeah, and this is why builders are motivated. The feds really control their rates. But for your home loans, not so much. Who's affected? Buyers. Do not time your purchase around a Fed meeting. You're timing the wrong instrument. Homeowners with a HELOC, you're directly exposed. If rates come down this fall, your HELOC payment comes down. Yeah, your HELOC payment comes down. Know your balance and know your index. Investors and anybody building, builder construction loans price off short-term rates. Every meeting where the Fed holds is another month of carrying costs on that spec home with the grass somebody has to mow. Which brings us right into the next story. The bottom line is Fed holds at 3.5 to 3.75%. Next call September 15th through 16th. Yeah, that's when they're going to meet again. So we looking out and we listening, ear to the ground. It moves your credit card, not your mortgage. Stop waiting for a meeting that doesn't affect you. Please and thanks. Story 5. Builders are still the most motivated sellers in America. Here's what happened. The NAHB, National Association of Home Builders, and Wells Fargo Housing Market Index for August came in at 35, up 1 point from July. Anything under 50 means more builders see conditions as poor than good. So 35 is not a happy number for them. The components, current sales conditions 39, up 2 points. Expectations for the next 6 months 43, which is flat. Prospective buyer traffic 23, which was also flat. And here's the part that matters to you. 63% of builders use sales incentives in August, unchanged from July. 35% cut prices, down slightly from 37% in July. The average price cut, a whopping 6%. That's 6% off the price. That's on average. So some people were getting even more than that. On new home sales, the most recent census HUD data showed a 628,000 annual rate, up 1.6% month over month, down 5.6% year over year, with the median new home price of $398,300 and 9.3 months of supply. NAHB chief economist Robert Dietz flagged something worth hearing. Homes priced under $300,000 made up 23% of June's new home sales, up from 16% a year earlier. Builders are building smaller and cheaper on purpose, because it saves money, of course. We know this. This is why it matters. 9.3 months of builder inventory versus 4.6 months in the resale market. Builders are sitting on double the supply of everybody else. And the builder is not an emotional seller. A builder has a construction loan accruing interest, a lender with covenants, a quarterly earnings call, and a finished house with a lawn that somebody is being paid to mow every week. That builder is the single most negotiable seller in American real estate right now. So go talk to him. With your agent, of course. Here's the 3 moves. Write them down now. 1. Bring your agent on the first visit, not the second. Almost every builder's registration policy says whoever's name is on the sign-in sheet the first time is who they're paying. Walk in alone, and you have given away your representation for free. And no, they don't discount a house for it. That money just stays with the builder. 2. Ask for the buy down, not the price cut. A builder will fight you tooth and nail over $15,000 off the sticker because that comp is now public and it prices every remaining house in the neighborhood. But that same builder will happily spend $18,000 on a rate buy down because a buy down is a closing cost credit that never shows up in the comps. Same money to you, completely different problem for them. Ask for the one that's easy for them to say yes to. 3. Ask which specific homes are finished and unsold. The pain isn't spread evenly. A builder does not care much about Lot 47 that hasn't been dug yet. A builder cares intensely about the finished spec that's been sitting 90 days. Ask out loud, which completed homes have been standing the longest? Then negotiate on that one. Here's the local read. Both my markets are heavy new construction markets, Houston especially. The outer ring, the master plan communities, the townhome infield inside the loop. Atlanta's growth counties, Forsyth, Cherokee, Paulding, same dynamic. If you're shopping new construction in either metro this fall, you're shopping at the moment of maximum builder motivation. Q3 ends September 30th. Nobody wants standing inventory on the books at quarter close. Bottom line, 63% of builders are offering incentives, 35% are cutting prices by an average of 6%, and they're sitting on 9.3 months of supply. Bring your agent on visit 1, ask for the buy down instead of the discount, and negotiate on the house that's been finished the longest. All right, this is the part of the show I've been looking forward to. If buying a home in 2027 is on your list, the single most valuable thing I can tell you is this. The work that determines what house you can buy in 2027 is happening right now in August 2026. Not, quote, when you're ready, now. Most people think they need about 90 days to get ready to buy a house. In reality, giving yourself a year or more is the difference between qualifying and scrambling. Here's the whole playbook. 6 moves. Move 1. Find out where your money actually goes. Before you think about a mortgage payment, know your real numbers. Pull 3 months of statements and write down monthly income, which is your take home, not the gross. Monthly expenses, all of them, including the ones you're embarrassed about. Yeah, the little dirty secret habits, put that in there too. Existing debt and minimum payments. What's in savings? Whether you have an emergency fund at all. Most people I sit down with find $200 to $400 a month they didn't even know they were spending. Subscriptions they forgot, a gym they don't go to, 3 streaming platforms that they don't even know the shows that they watch on anymore. Over 18 months, that's $3,600 to $7,200 in the bank. That's not coffee, that's your closing costs. Move 2. Save for more than the down payment. This is where people get blindsided. Your savings target needs to cover your down payment, closing costs, realistically 2% to 5% of the purchase price, your moving expenses, immediate repairs and maintenance, furniture and appliances if you need them, an emergency fund that survives the closing. That last one matters most. Do not put every dollar you have into the down payment because the water heater does not care that you just closed. The water heater has its own plans. And on down payments, the myth that you need 20% has cost more people more money than almost any other belief in this business. NAR's most recent buyer profile puts the median first-time buyer down payment at 10%. There are loan programs that go lower. There are down payment assistance programs in Georgia and Texas both that most buyers never hear about because nobody told them to ask. Listen, ask. Move 3. Protect your credit like it's a job. Your credit score moves your interest rate, and your interest rate moves your payment for 30 years. Between now and 2027, pay every bill on time. Payment history is the biggest single factor. One 30-day late payment can cost you real points. Number 2, keep credit card balances low relative to limits. Under 30% is decent, under 10% is better. Number 3, don't open a bunch of new accounts. Every application is an inquiry, and a new account drops your average account age. Think there's a rule about 2 inquiries every 24 months, or don't hold me to that. We'll have to research that. Have to bring in the credit experts. Check your reports for errors. All 3 boroughs. Errors are more common than people think, and disputing one is free. Keep chipping at the debt. Lower balances, lower DTI, more house. And one important note from the news, Fannie Mae and Freddie Mac eliminated the 620 minimum credit score on conventional loans. If a lender told you no in the last 2 years because of your score, go get requoted. That's not a sales pitch. That's a policy change. And a lot of people who were told no are now getting that yes. So go do it. Move 4. Don't blow it up in the last 6 months. Lenders want boring. Between now and your closing, don't finance a new car. Don't take out a large personal loan. Don't max out the credit cards. Don't ball out. I'm telling you, don't do it. Don't change jobs without thinking about how it looks on paper. That doesn't mean life stops. It means you call me or your lender before you do that one thing, not after. I've had a buyer buy a truck between pre-approval and the closing. It was a great truck, but he doesn't live in the house though. Move 5. Learn to market a year early. You don't have to wait until 2027 to learn what things cost. Start now. Pick 3 neighborhoods and not 15. 3. 1, 2, 3. Set up alerts and watch what actually sells, not what's listed. List price is an opinion. Sold price is a fact. Watch how long things sit. So back to that days on market. Y'all remember that? Learn what $400,000 buys in each one and how that changes over 12 months. Figure out which features you actually care about versus which ones you think you're supposed to care about. By the time you're ready, you'll know within about $15,000 what a house should sell for on any given street. That knowledge is worth more than anything negotiating tactic, anything that I could teach you, anything that you could just learn off the internet. That right there is you doing the research and you being an expert in that neighborhood. Move 6, get an agent in your corner now, not later. I know how this sounds coming from me. Sit with it anyway, y'all. The single most expensive thing a buyer can do is show up to an agent 8 days before they want to make an offer. At that point, I'm doing damage control. I'm finding out your credit needs 4 months of work or your DTI is off. Or you've been looking in a price band that doesn't exist in your target neighborhood. Bring me in a year early and I'm doing something completely different. I'm connecting you with a lender who will tell you exactly what to fix. I'm sending you sold comps every month so you learn to market on your own. I'm telling you which neighborhoods are about to get a new elementary school and when the right house shows up. And it always shows up when it feels inconvenient. And my goal is to have you ready, not hopeful. I mean, you can be hopeful too, but ultimately you got to be ready. There's no cost to that conversation. There's no obligation. I'm not going to call you every week. The bottom line, buying in 2027 is a decision you execute in 2026. Know your numbers, save past the down payment, protect your credit, keep your financials boring, learn 3 neighborhoods cold, and get a professional in your corner a year out. Small, consistent steps beat a heroic sprint every single time. Selling this fall, get an insurance quote on your own house before you list. You want to know that before it costs you a buyer in week 6. Buying in 2027, open a separate savings account this week and name it. Not, quote, savings, end quote. Name it, quote, house, end quote. Automate a transfer on payday. Behavioral studies are boring, but the one about named accounts is real. People don't rate a labeled account nearly as often. Your questions. Question 1. My insurance renewal came in $600 higher and I didn't file a single claim. Can they do that? Yes. And it probably has nothing to do with you. Carrier is priced by risk pool, not by individual. Storm losses across your region, higher rebuild costs, and reinsurance pricing all flow into your renewal. What you can do, shop it with an independent agent who quotes multiple carriers, not one captive brand. Raise your standard deductible if you have real emergency savings, and send in documentation of every upgrade you've made in the home. It won't always work. It works often enough to be worth an afternoon. Question 2. Should I wait until after the September Fed meeting to buy? No, and I say that with love. The Fed sets an overnight bank lending rate. your mortgage prices off the 10-year treasury and mortgage-backed securities. They are related the way your cousin is related to you. Same family, different house. What you'd actually be doing by waiting 3 weeks is competing with everyone else who waited 3 weeks. If you find the right house at the right price with a payment that works, buy the house, y'all. I want to buy in 2027. Is it too early to talk to an agent? It is the opposite of too early. 12 to 18 months out is the best time, and it's the window almost nobody uses. That's when we can actually fix things. Credit, DTI, saving strategy, neighborhood selection. 8 days before you want to write an offer, all I can do is react. A year out, we can plan. No cost, no obligation, no pressure. And here's the takeaway, guys. The school buses are running, summer's over, and the market just got quieter, slower, and a whole lot more negotiable. Somewhere out there this week, somebody's gonna lose a house they loved over an insurance quote they didn't order until day 19. And somebody else is gonna walk into a builder's model home alone, unrepresented, and leave $30,000 on the table without ever knowing it was on the table. Neither of those people is dumb. Both of them just didn't know. Now you know. Nobody's going to hand you a perfect moment. There isn't one. There's just information and what you do with it. The people who build real wealth in real estate aren't the ones who timed it. They're the ones who understood it and moved. I'm Mickey Lawrence, licensed in Georgia and Texas. Subscribe so this shows up for you every week. It's free and it's the biggest thing you can do to help this show find the person who needs it. Drop your questions in the comments. I read every one, and the best ones become segments. And share this with one person who's been talking about buying for 2 years and hasn't moved. This might be the episode that makes it click. 770-373-4944. settleinatl.com. At List with Mick everywhere. Free buyer and seller guides on the site. No cost, no gimmick. Take care of your people. I'll see you next week.